In 2019, Uber made an interesting statement. The statement was in an S1, a mandatory document for companies going public. It offers the first detailed look at their finances, and it's Uber's opportunity to convince the public why they should invest with it. If you read through it, you'll see big plans for driverless cars. You'll see profit and loss statements. Dive into the risk section, and it's more than a warning about potential pitfalls. If you look closely, you'll find Uber's plan to make profit, hidden in plain sight. As we aim to reduce driver incentives to improve our financial performance, we expect driver dissatisfaction will generally increase. Translation: we plan to turn a profit by paying drivers less. In 2023, it finally happened. After losing $33 billion, Uber turned an operating profit for the first time in company history. The stock price doubled. This milestone made headlines, and management took a victory lap.
It's the amalgamation of a ton of work, and we plan to be profitable for, every quarter going forward.
Management said the profit came from diversifying into food delivery and freight. They dropped some buzzwords about innovation and efficiency, but there's a growing chorus of major business school professors who have a much more simpler explanation, one that calls back to Uber's original stock filing. Those profits came directly from a driver's cut of each ride. So who's right? Well, let's take a look at the evidence, the academic research, the financial statements, and we can understand why Uber could now view controlling this debate just as important as their app functioning. Because if the truth gets out, Uber's profits could be in serious trouble.
In the early days, Uber used investment capital to subsidize driver pay and passenger fares.
This is Mariah Montgomery. She's the National Campaign Director at Power Switch Action.
And we're working alongside rideshare drivers in different cities who are fighting for better standards and more protection on the job.
When the company started, Uber lost money on every ride. Your ride was cheaper and the driver made more because investors subsidized everything. Some analysts believe that investors paid for 40% of every ride because they were trying to capture what they call a liquidity network effect. Basically, they were trying to build a big network full of riders and drivers, and it worked. But now that the company is public, their demand isn't for scale, it's for profit.
Uber has 75% of the ride-hail market nationally now, and they have taken advantage of that as demands from investors have changed.
I think that the era of pricing, of fighting purely based on price is over, right? That was 3-4 years ago when it was just about volume, but investors now want profitable volume. And if the only thing you have to offer is a lower price, you're not offering much ultimately.
In December 2023, Columbia Business School professor Len Sherman started crunching the numbers. Working with reliable third-party data, he found that Uber's profitability was easily explainable if you were willing to admit something unsaid in polite circles. Basically, Uber was charging consumers more and paying drivers less. The charging more was obvious. Like nearly every other company, Uber raised prices throughout the pandemic, way more than inflation. Fares are up 65% since Uber went public. But proving that Uber was paying drivers less was tricky because management hardly gave clear answers. According to Sherman's analysis, at the start of 2022, the average fare was about $21, with the driver earning a little over $13. That means that Uber took home the remaining amount, or 35%. By 2023, the average fare was up to over $21, but drivers, they were making less. Uber's take increased to over 40%. How did they pull it off? Well, technology. Historically, drivers were paid based off of trip distance and duration. With this, Uber flipped the script with something they called upfront fares plus destination. This new system uses a complex secret algorithm that weighs a bunch of different factors to set prices. On the upside, drivers can now see their pay and destination before accepting a ride. On the downside, there's a growing concern that Uber might be pushing drivers into a corner, offering drivers who skip the less lucrative fares fewer rides, which creates a race to the bottom. Sherman isn't alone. Investment analysts are coming to similar conclusions. A forthcoming paper, spearheaded by a Wharton School professor, found that in New York City, Uber's take rate has increased significantly, while Lyft's has decreased. Last year, we published a video with an organization called Get Fair. They found that Uber's take during surge prices was over half. Since the introduction of upfront fares, Uber's profit margin has expanded. Uber disputes that they're taking more money from drivers, and we don't know for certain who's right about this, because Uber refuses to share the actual data. To paraphrase that Wharton professor, Uber's written response to all of this is essentially, you're not seeing what you're actually seeing. Your eyes are lying. Right now, Minneapolis politicians are actually listening to the research and drivers. They passed a minimum wage law for rideshare operators within the city. As a result, Uber is threatening to exit the entire state, arguing that wage regulations could make operations unprofitable and force them to increase prices.
We wanted to test that claim.
Her team analyzed millions of rides across two similar markets, Chicago and New York. Both are densely populated major US cities.
And they're the only two cities in the US that we're aware of that make data on fares at the trip level, every single trip, available to the public.
Uber is forced to turn over that data by those governments.
They're also a really good comparison because they have one major difference, which is New York has had a pay standard since early 2019, and Chicago currently does not have any kind of pay protection or pay standard for drivers. What we found is that over the 4-year period after New York put its pay standard in place, fares in Chicago actually rose at a higher rate than they did in New York, which is the opposite of what you would expect if Uber's claims were true.
This isn't the first time that Uber has misled the public about their business. A whistleblower revealed that when Uber was expanding across Europe, they paid economists to produce research praising the company. They then fed that research to journalists to support their cause.
You can't trust Uber's claims because they've too often been shown to be misleading the public.
And right now, Uber and Lyft don't release detailed data around driver pay, prices, and take rates. Instead, they flood the airwaves with talking points that run counter to independent research and their own stated strategy.
I think, policymakers should treat it like a negotiation that's happening via the press, which I know is uncomfortable, rather than, a good faith response to public policy.
Cities now face a crucial call to mandate that these rideshare companies open up their trip data. This would not only arm drivers with the knowledge of their earnings and strengthen their push for fair wages, it would give politicians and policymakers information they need to actually make a system that works for the city, not for the company.
I don't trust what Uber says. They have too much of a track record of misleading the public for corporate gain, and drivers have a lot of information about how the platforms actually work, and we should give a lot more credence to what they say about what they're experiencing every day. These companies need our cities. Cities are where they make all of their money. They don't want to leave. Yes, they're throwing their weight around, but we as cities, as the public, as elected leaders, should throw our weight around as well to do what we need to do for our constituents.
Thanks for watching. Be sure to like and subscribe to our channel. If you have ideas for stories you want us to uncover next, please drop them in the comments below.